The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Equity investors crawl out of their hole, and so too do the bond vigilantes. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Stocks rebounding from the S&P 500's first weekly decline since early September. We, of course, have a busy week of earnings coming up. However, you have Treasuries resuming their sell-off, pushing yields higher. Lots of supply coming into market this week. The 2-year and the 5-year notes hitting the auction block today. Oil prices plunging down around 6% for both Brent and WTI after it became really clear that Israel had largely spared Iran's oil facilities, so taking some of that risk premium out of the oil market. And yen weakness down against all G10 currencies. A lot of political uncertainty in that country after the ruling LDP party and its coalition lost the majority in parliamentary elections.
All right, markets really need to hold on to their hats. This is a potentially big week for potential market catalysts with a major jobs print coming from the U.S. government. Almost 200 earnings reports from S&P companies and a consequential announcement on borrowing needs from the Treasury. Financing needs coming as benchmark yields now approach 4-month highs, with confidence waning for those aggressive rate cuts and confidence plummeting in Janet Yellen's ability to avoid ramping up borrowing. Now, the Treasury just moments ago did actually prime investors for what to expect, saying its estimates for the year, for the rest of the year, that it will need to borrow $700 billion in this quarter in privately held net marketable debt. That compares to a previous estimate of $565. So a huge bump up here in that estimate that was made just 2 months ago. It also told investors for the first quarter, prepare yourselves for $823 billion in debt sales in the first quarter of 2025. And that compares to the previous estimate of $748 billion sold in Q1 of 2024. Now, we did have a separate quarterly refunding announcement for existing bonds. That will come out on Wednesday. And all of this is really shining a spotlight right now on ever-growing government spending that Ed Yardeni says at some point will require a meaningful increase in the sizes of longer-term debt sales. Yardeni, of course, made a name for himself with that seminal paper in 1983 that argued when fiscal and monetary authorities won't regulate government spending, bond vigilantes will.
The reality is that the dollar's actually strengthened at the same time as the bond yield has gone up. So that suggests that there are people who are concluding that if the bond vigilantes are getting the message out to the Fed that they don't want any more rate cuts, that they think it was premature.
And this is going to be a big focus, Scarlett, for the bond market over the next few days, particularly, of course, with a pivotal U.S. election, not just the presidential one, but the congressional race as well.
Absolutely. Yeah. And it's not just this week either, because you look at what's going to happen over the next 2 weeks. The bond market confronts back-to-back-to-back event risks, including inflation data, a jobs report, and a Fed decision. And, of course, the election as well. Since late September, there's been a very clear trend. Treasuries selling off, and that, of course, pushes the 10-year yield higher. That is the yellow line here, while the dollar strengthens, that is your white line, as betting markets reflect rising odds of a Donald Trump victory, and that is the blue line. They're all moving in tandem here. Donald Trump's low-tax, high-tariff platform is seen boosting economic growth as well as inflation, which, of course, would then push out more Fed rate cuts. Romaine?
All right, and just a quick correction before we start. The Treasury did release its borrowing estimates for the current quarter that we're in. That number is coming in at about $546 billion. Just to be clear, previously I said it was $700 billion. That $700 billion is the year-end cash balance that the Treasury expects to have. So $546 for the current quarter. That compares to the previous estimate they made 2 months ago of $565. Now, for the first quarter of 2025, they're anticipating roughly about $823 billion in net borrowing for those marketable securities. That's for the January to March quarter, and that is significantly higher than the previous estimate it gave just a couple of months ago. Jay Berry is the managing director and head of global rate strategy over at JPMorgan, and he joins us now to kick us off to the close. And Jay, let's focus in a little bit here on the Treasury's borrowing needs. I think everyone knows that at some point those borrowing numbers are going to have to come up significantly. It looks like, at least for the first quarter, they seem to be guiding in that direction.
Yeah, I think that's right, Romaine, and thanks for having me on this afternoon. In our baseline, and the borrowing estimates we got, I think for this quarter, we're not too far off from our expectations. And for the first quarter, probably a little bit larger. But I think what we know is that for fiscal year 25, which has just begun, the Treasury is probably in a pretty good spot with its long-term auction sizes, but that the closer we get to August and November next year, as you sort of quoted from Ed Yardeni, there's a strong likelihood that Treasury will have to resume its increases to long-term auction sizes, probably in both a magnitude and duration. That looks just as big as we saw last summer through this spring. But in our minds, we think the Treasury is probably in a good spot for the next 9 to 12 months or so, even though these announcements for the first quarter were larger than expected.
This raises a lot of questions, though, Jay, about the trajectory of interest rates. I mean, if we just take the benchmark 10-year, which, of course, right now back at that 4.2, 4.3 level, and in a time where we were expecting that number to come down because of the presumption of additional Fed rate cuts, how is this all going to balance out? If the Fed does continue to cut rates, but the Treasury's borrowing needs continues to go up, is that just going to keep us pinned in a tight range on the Treasury notes?
Yeah, so I think a lot of this increase that we've had over the past month or 5 weeks or so remain has been a function of the action the Fed took last month by delivering an aggressive 50 basis point cut. I think it was a sign to markets that the Fed does not want this expansion to end prematurely, and there's a likelihood of better growth and inflation outcomes down the line, meaning less easing. And we've seen that because the terminal Fed funds rate priced into markets has risen from about 260, 270 in the middle of September to something like 350 right now. So it's certainly reflective of fewer eases coming down the line. But to your question on what it means when we intersect monetary and fiscal, in our minds, the primary driver of Treasury yields is always going to be the market's medium-term monetary policy expectations. Mm-hmm. But away from that, we do think that for a given level of policy rates, because of this 100+% debt to GDP ratio and a Treasury buyer base, which is shifting from price-sensitive or price-insensitive buyers to price-sensitive, it's just going to mean long-term rates remain more elevated for a given policy rate than we've seen over the last 15 to 20 years. So in all else equal, we really think it results in steeper yield curves as well.
So, Jay, when we look at the sell-off in Treasuries right now, I mentioned how Treasuries have resumed their sell-off from, over the past month, really. Is this actual positioning for an outcome, or is there something else muddying the picture, like hedging?
Yeah, so I think, Scarlett, that a lot of this has been fundamentally driven because of the shift in the Fed's reaction function, but also because the data has proven to be more resilient, both on the labor market and on the inflation side. But that being said, when we look at the move in long-term yields adjusted for sort of their typical fundamental drivers, it's been in excess of what we would have expected. And while it might be tempting to attribute this to a shift in electoral expectations, I think the bigger issue here is that we've not quite caught up to where growth expectations have gone. And further from that, positioning, at least on the duration side, was pretty long heading into the September Fed meeting. And it's been sort of washed out and is much more neutral right now. So everything I've heard from clients being on the road the last couple of weeks is that this has been a fair amount of de-risking and that clients would rather react to the election rather than proactively position for it, given how close it seems like it might be.
Interesting. So that means that we could see a lot of volatility in the days right after the election. I'm wondering how you're thinking about the sell-off that we're seeing in oil, because lower oil obviously helps to improve the inflation picture in the months ahead.
Yeah, I think it's certainly indicative of lower burn on geopolitical pressures, given what happened over the weekend. And while I think it might be tempting to think that it is certainly reflective of lower inflation and a better outcome for this consumer, it probably means we can go back to kind of thinking about the prospects for growth, inflation from a sort of more macro fundamental perspective rather than having to think about geopolitics, which means that any sort of premium that had been built into the rates market from the energy market is probably dissipated. And I think as we go forward, our colleagues in commodity strategy think that as we head into next year, it's likely to be that supply will outweigh demand, given ongoing strong supply from OPEC Plus, which means that oil prices, if we're in a more stable world, are likely biased somewhat lower.
And obviously, a lot of this is going to hinge on the outcome of the U.S. election. Two different candidates with some very clear differences in policy, and that could have a big impact here on Treasury funding as well as just how the market reacts to it. I am curious, Jay, just in the short term here, we have an election a week from tomorrow. Are you going to be up on Tuesday night watching the results? And if so, what parts of the market do you think are going to react, or are you anticipating are going to react first to the outcome?
First, Romaine, I'm definitely planning to be up late watching the results. And I think the parts of the market that I'll be watching, first, the short end of the inflation curve, because the work that we've done has indicated that if you see a divided government with a Trump victory, and that likely means more tariffs globally, that's likely to raise the price level by about 1.5%. And we've seen that through the summer as the probability of a former President Trump victory has increased, that has meant that short-term inflation expectations has risen, so I'll be watching that. Second from that, I'll just be broadly watching the slope of the yield curve because you've talked about the fiscal picture, and we've said that a sweep in either direction is likely to mean meaningfully more borrowing than the baseline that we've heard from the Congressional Budget Authority. And that means, given the focus on term premium and the shift in demand that we've talked about, against the backdrop of what is a pretty strong economy, likely biases the yield curve higher and steeper, but to varying degrees, whether it's a Trump win or a Harris win in the event of a sweep. So I'll definitely be watching the front end of the inflation curve. We'll be watching the slope of the Treasury curve and the outright level of yields as well.
Yeah, 2/10 curve right now, still mired in tight trading space, right around 13. Jay, always a great conversation. Jay Barry, Managing Director and Head of Global Rate Strategy at JPMorgan, kicking us off to the close here on this Monday afternoon. When we come back, we're going to take a closer look at the world of tech, a closer look at Apple, which finally seems to be taking a bite out of artificial intelligence, rolling out its first AI features today, Scarlet Fu, just days before reporting quarterly results. A discussion on how Apple Intelligence could shape Scarlet Fu's buying decision for her next telephone.
Yeah, I'm still not convinced. Yeah. Plus, investors are revving up shares of Ford ahead of the auto giant's quarterly results due out after the bell. We're going to dive into what's driving Ford's financials as it tries to bring down sky-high warranty costs.
And from company politics to American politics, and a look at what could happen to one of America's strongest alliances. Rose Gottemoeller is a former Deputy Secretary General of NATO. She'll be joining the big program in just a few minutes. Stick with us. This is The Close on Bloomberg.
November 5th, election night is here. Trust Bloomberg for up-to-the-minute results as the races for the White House and Congress are decided, as well as detailed analysis of what it all means for the economy, markets, geopolitics, and more. Tune in at 5 p.m. Eastern for an extended balance of power leading into full team coverage at 7 live from the battleground states and Harris and Trump HQ. It's election night on Bloomberg. Context changes everything.
Investors picking up shares of Apple after the tech giant unveiled its personal AI system, Apple Intelligence. It's available today on the iPhone, the iPad, and Macs. Apple reports its quarterly results later this week, along with some other big tech names. Here now to discuss is Anurag Rana of Bloomberg Intelligence. And Anurag, this is a bit of marketing here for Apple before it does report its results on Thursday. Just to be clear, this latest AI offering does not involve anyone buying new devices. It's more just activating the new devices that it had already released, right?
Yes. So if you look at it, the Apple Intelligence will work on all the 16 models and the 15 Pro and Pro Max. So if anybody has those models, they should be able to update the software and run the features. The question is going to be, are these features compelling enough to go back to those people who have, let's say, an iPhone 12 or a 13 to upgrade? And we think it's going to take time to create that buzz because, first and foremost, the features are being staggered and released over time. Second, they're not going to be available in EU and China anytime soon. So we think, it's going to take, let's say, about 12 months or so for a big suite of those features to come out, and that's going to excite consumers perhaps a year from now.
It's going to excite consumers perhaps a year from now. So this is a long lead up. I mean, what's the risk here that Apple Intelligence is going to end up being something like the Vision Pro Quest, which, unleashed and launched to a lot of fanfare, but, at this point is still just kind of a thing for Apple diehards?
I think it's a low probability of that because Apple's very careful in announcing these features and releasing them. They are really working hard in terms of explaining what is going to be on the device, what's going to go to their private cloud, what's going to be on OpenAI. Because as you know, more than half their revenue comes from the iPhone, so they really cannot disappoint consumers with that experience. I think they're going to be very careful with those features.
So give us a sense here of what features. If I update my phone on this new update, what exactly am I going to be able to do different today that I couldn't do yesterday?
You see, as far as today is concerned, it is going to be a lot more summarization, trying to do very much what you would do with a Copilot, maybe a little bit of the pictures. But down the road, it will understand who you are as a personalized user and give you a lot more of that context. But again, that's going to take some time. Even the OpenAI integration. So suppose I'm looking for an answer for something that's complicated, and I ask that question to Siri. It's going to give me an option of doing it what they have currently, or running it through OpenAI, which then goes to a cloud server and returns it back. So a lot of those, I think it's going to take some time for that to trickle down.
All right, Anurag Rana over at Bloomberg Intelligence. A closer look here at the new AI features, some of those features being unveiled today by Apple. We have to wait a couple more months for, I guess, the more important ones, the ones that integrate with ChatGPT, and the ones I'm more interested in, which is being able to sort your email box and things like that.
Saving you time.
Be more useful than that here. But it gets into this whole arms race right now in the AI space, and there was a great story about some really heavyweight investors, including Stan Druckenmiller and a few others, investing in Reflexivity, which is basically a research firm, but they're powered by AI. The latest funding round here, and a $30 million investment here by this group of investors. And it gets to this idea here that people really are trying to find a way, or at least find the beneficiaries of this whole AI boom.
Yeah, and it speaks to the idea that the low-hanging fruit has already been picked, right? You look at utilities, which have done very well because they're expected to get a big boost from the increased use of AI by data centers. Reflexivity, this new market research firm, says it can provide insights into more than 40,000 stocks, bonds, and commodities to try to figure out what are your next bets.
Yeah, and it'll be interesting, too, because it also boils down to what they're charging and whether folks are willing to pay for it, like whether the juice is really worth the squeeze here. But nevertheless, here, Stan Druckenmiller, Greg Coffey, and Thomas Petterfy joining in a $30 million funding round for Reflexivity. When we come back after the break, we're going to take a look at shares of Alaska Air flying higher today on what's expected to be a bullish cycle for U.S. airlines. At least that's according to the analysts that we're going to talk to right after the break, right here on The Close on Bloomberg. All right, time now for our top calls, the big movers on the back of analyst recommendations. And we're going to start off today with Honeywell, a downgrade to pure perform over at Wolfe Research, with the analyst saying Honeywell's struggles over the past 2 years makes him less optimistic the company can overcome headwinds for the next 12 months. He also sees risks of another wave of negative earnings estimate revisions. Shares of Honeywell down for a fourth straight day. Next up, let's take a look at Colgate-Palmolive, a downgrade today to hold from buy. This over at Stifel. While Colgate's fundamentals are more than solid, the analyst expects organic sales growth to slow over the next few quarters. He also expects rival Procter & Gamble to accelerate while Colgate decelerates given tougher comparison. Nevertheless, Colgate shares up fractionally on the day. And finally, let's take a look at shares of Alaska Air. Soaring today after Melius Research upgraded the carrier to buy from hold. The analyst says he's more bullish on airlines now than in a long while. He sees positive synergies from Alaska Air's purchase of Hawaiian Air, as well as upside from what he calls one of the strongest management teams with top market share in the Pacific Northwest, California, and now Hawaii. Those shares up about 4% on the day, and those are some of our top calls. Pleased to say that, well, the analyst behind that last call joins us right now. Conor Cunningham is a travel and transports analyst over at Melius Research. And Conor, let's get right to it here. I do want to start off first with the idea of the merger between Hawaiian and Alaska and how this improves the overall picture for the combined airline.
Yeah, so why Alaska did this purchase to begin with makes a ton of strategic sense. They tend to want to be in markets where they know they can dominate and have a really strong position. They want to be relevant to all of their customers. So when you think about Alaska's just hub network right now, you know, they're number one in Seattle, number one in Portland, and now number one in Hawaii. They're also very relevant up and down the West Coast in California. So from their perspective, it's all about being relevant and making sure that you have the right position in the right product that your customers want to fly. So the Hawaiian acquisition will ultimately be a nice benefit to the overall company when it's all said and done.
How much exclusivity do they have with regards to their routes? Meaning, how much competition do they have?
Hawaii is an incredibly competitive market. Every airline is within it. These guys will, on a combined basis, will have about 40% market share from off the West Coast to Hawaii. So they will be a dominant player for sure. But it is a market in which tends to be have a lot of discounting because it's a very leisure oriented and so on. So, but Alaska again is from as you indicated in the lead-in, this is one of the best management teams out there. They know how to make money and make sure that they're putting the right product out there in the right routes.
Okay, so you've been praising Ben Menikuchi's team for a while here. What does he do better than the others, say Bob Jordan over at Southwest?
It's a good question. So the difference between Ben and Bob is that Ben is at the roots of what he's done historically has been more of an operator. He knows how to run the airline, whether it's just overall ops, which has been incredibly important over the course of the cycle. So Bob's just a different character, but they do both represent the culture of the company, and that's incredibly important. Ben is just this has been a management team that when they say they're going to do something, they do it, and you can kind of bet on them.
Got it. All right, Conor, the other thing is, of course, the DOJ gave the green light for this to happen, but the two airlines needed to make some concessions, like protecting the value of loyalty reward programs, maintain existing service on key routes, preserve support for rural service. Does that cost anything? Is that going to affect the financials here?
It really shouldn't. At the end of the day, the concessions here were pretty minimal. They didn't have to give up a lot of slots or gates or anything like that. That would have hurt the overall value of the merger in general. So I from my standpoint, the DOJ really didn't push back all that much. It made a lot of sense. I think the issue that they're dealing with is that the state of Hawaii really wanted this to go through as well. So there was a lot of support from people on the ground.
I am curious, though, about just the overall health of the airline industry right now, beyond just what's going on with Alaska Air. Do you see, I guess, a little bit more balance between their cost structure, between demand, between capacity, et cetera?
Yeah, in the note that we put out this morning with the Alaska upgrade, we have a pretty bullish stance on the overall group. We akin it to the time frame of late 2012 to 2014, where the airlines had they were really disciplined with their overall supply, and that resulted in margins going up over 500 basis points over the next 2 years. So the setup is very eerily similar right now. From our standpoint, the stocks could be in a big bull cycle, led by Delta and United and now Alaska. So that's basically where we're focused. We think that the opportunity on the pricing side is pretty immense, and the overall demand is still really solid.
Right.
So it's more about having a better supply-demand balance out there.
Got it.
And that is very much in their favor.
All right, Conor Cunningham over at Melius Research. Thank you so much. Coming up, we're roughly 1 week out from the U.S. general election. We'll speak with the former NATO Deputy Secretary General coming up next on The Close. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Boston.
And I'm Scarlett Fu. We're about a week away from the U.S. election, but it feels like the news flow is not ending at all. You have so many different points to cover, whether it's earnings, whether it's what's happening on the geopolitics front, whether it's elections in places like Japan.
Yeah, and we get to this idea, too, of kind of the new world order being upended. And this has been a slow-moving process that's really taken place over the last couple of decades. But it feels like we're kind of coming to a head, and a lot of hard choices are being made, not just here in the U.S., but overseas as well.
Yeah, wasn't it someone who said things are happening slowly and then all at once? And it kind of feels like that's where we're headed right now.
Yeah.
All right, well, Republican vice presidential candidate J.D. Vance trying to appease those who are fearful of a U.S. retreat from NATO under a potential Trump 2.0 term. He told NBC's Meet the Press that Donald Trump would keep the U.S. in NATO if reelected, but criticized some NATO countries, namely Germany, for not carrying their share of the defense burden. Joining us now for more on this is Rose Gottemoeller. She's a research fellow at the Hoover Institution, a lecturer at Stanford University's Freeman Spogli Institute. There we go. And former Deputy Secretary General of NATO. It's a lot of titles there. I apologize for tripping up on that, Rose. Thank you so much for joining us. Vance saying that Trump would keep the U.S. in NATO, how reassuring is that, given that European leaders have some pretty, delicate memories of Trump 1.0 from the first time around?
Yes, that's very clear. While I was Deputy Secretary General at NATO, Trump was frequently threatening to withdraw from NATO. And even on the campaign trail earlier, he has said some pretty sharp things about Putin being able to do whatever the hell he wants with NATO countries if they don't pay up. So I know this was an abiding worry among our NATO allies in Europe. And so J.D. Vance's words on the campaign trail, I think, will have some effect of comforting the allies, but they cannot let up in any way on what they've been doing now for some time, and that is raising their defense spending. They're doing it now, not so much in response to Trump and his threats, but to the threat of Russian aggression against Ukraine that they are concerned could come to affect Europe also. So I do think that the European allies are going to stay on that track now, but it's good we've heard something a bit more positive from J.D. Vance about NATO.
Yeah, well, we'll see if they hold to that, if it comes to that. You mentioned Russia, so I wanted to get your take on the BRICS summit that took place in Russia last week. Vladimir Putin has made a really big show of positioning Russia as the leader of the global south, spearheading efforts to move, for instance, beyond the U.S. dollar-based financial system, among other things. How are you thinking about this, and why does it feel like it's not getting as much attention as other things?
Putin very clearly was using the show in Kazan last week to convey his notion that the world needs to move away from the United States of America and, as he puts it, its weaponization of the dollar. And of course, Russia has suffered, and rightly so, under severe sanctions that the United States and its allies have put in place during its war of aggression in Ukraine. So Putin's reacting to that. Xi Jinping joined him on stage. They look like an impressive couple. But on the other hand, all the other members of the BRICS, I think, including China itself, they're trying to play a balancing act. Perhaps they would like to have less of that influence of the almighty dollar, but on the other hand, they recognize the degree to which the dollar and the U.S. financial system really continues to dominate the world as a whole and the world economic system. So they can't afford to walk away from the United States and from Wall Street and everything that is represented by the dollar's strength. So I think it's a balancing act for most members, but not for Russia.
Well, I am curious, though, Rose, when we talk about this idea of not walking away from the United States, whether we're talking about Russia or China or one of the other sort of up-and-coming powers here, there has been this general idea that they certainly don't have to be completely in the vortex of the U.S., meaning following our policies and following our direction. The idea that you're going to have different spheres of influence around the world, and I guess, if you believe China, they'll, of course, be the center of one of those spheres of influence. Is that a world that the U.S. can live with, or are we going to continue to try to push this narrative that we are still the preeminent power and everyone should follow our lead?
As far as Washington's concerned, we'll always be the indispensable nation, I think, although that is a point that the Trump team has been making, that the United States no longer has the resources to be astride the world in every corner. And I think the U.S., in fact, should always make decisions about its involvement based on a consideration of its own national security concerns. And so, long story short, I think we are seeing a situation where regional powers, and you see them in the BRICS, countries like Brazil, countries like South Africa and India, they will increasingly be exercising power in their regions and looking for partners to do so. Sometimes that will be the United States, sometimes it may be China, and I think that is the world that we will see in the future.
If you were in a position where you were advising, let's just say the new administration, whoever that might be, come January, what's kind of the big piece of advice you would give them with regards to the approach to U.S. foreign policy? And in that, I'm wrapping in not just, warfare and the geopolitical conflicts, but also things like tariffs and trade conflicts as well. Is there sort of some advice you can give the new president as to how to approach whatever this new world order is going to look like?
I always start with U.S. national security interests and national interests overall. So that means a clear-eyed view of what's best for the U.S. economy, as well as for the strength of our political system. So I do think that calculation is where any new president has to begin. And in some cases, it may mean a reprioritization and an effort to say, okay, now we're going to, for example, focus on Asia more. But, every single U.S. president since Barack Obama and his pivot to Asia has been heading in that direction. So I do think that there'll be some careful calibration, but, we'll see where we go.
Yeah, that's a really good point. I was just thinking about that pivot to Asia and how it's been long in the tooth. Under a potential Harris administration, who do you think the U.S. will say is its most reliable ally? Who do you think will actually be its most reliable ally?
Well, the United States is lucky because we have a lot of really good allies, and that's one of our strengths, as well as an aspect of our prosperity, is having good allies who want to work with us on our defense and national security, but also want to trade with us. And that's one thing that makes our economy so vibrant and healthy. So I can't say who's going to be our best ally. I can say traditionally, countries like the United Kingdom, the UK, have been very important U.S. allies. But I think our allies in Asia, Japan and ROK, Australia, New Zealand, these will increasingly become important as the United States is building up its ability to deter and defend in Asia as well.
Rose, given the time that you spent as Deputy Secretary General over at NATO, I do have to ask you just about the future viability of NATO, at least in its current conception. Whether you have Trump sort of pushing back on whether we should belong or continue to contribute the same amount of money, whether the fact that you have certain countries within NATO that, let's just face it, are probably a little bit more aligned with Russia and China than they are with the Western superpowers. Is there an argument to be made that maybe NATO in its current form should be shrunk?
I think quite the opposite. I think the war in Ukraine, Russia's aggression against Ukraine, have proven the enormous value of NATO as a security organization and really a deterrence and defense organization. It's got the United States back in Europe. Again, this is going to be super valuable if the United States is going to need to be spending more time and attention in Asia. And I think the fact that Europe has really had to build up its defense capacity, and we see that now. By the way, Trump did start that going during his first term, pushing them to spend more on defense. But it's really Putin and the threats that he poses that have pushed the NATO allies in Europe to strengthen defense industry, to build up their capability to modernize and replace weapons provided to Ukraine. So a lot has happened in NATO to make it a more coherent and strong organization than it was even 5 years ago.
All right. Well, if anyone would know, you certainly would. And we really appreciate you taking time for us today, Rose. Rose Gottemoeller there is the former Deputy Secretary General over at NATO. A closer look here at the potential changes in U.S. foreign policy based on the outcome of the November 5th election. When we come back after the break, we're going to refocus here on U.S. markets and one of the big movers on the day on semiconductor. The shares are riding high after a strong earnings report. We're going to have a discussion here about what the future means for that company. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. Taking a closer look at shares of ON Semiconductor, up about 2% here on the day. After reporting third quarter results, sales were down, but they did beat expectations. And the guidance for the fourth quarter also coming in slightly above what the street was looking for. Bloomberg reporter Emily Grafeo joining us right now to talk a little bit more about this. And I was going through the transcript of the conference call a little bit earlier, and there was a lot of talk in there about this L-shaped recovery that we're going to see in the chip space. Not quite there yet. And that was certainly reflected in the third quarter numbers. But it looks like investors are more focused on the future and the potential growth that this company might have.
Yes, Truist Securities said that their outlook was a hair below consensus, but their inventory remains well above the company's 115 to 120-day target. So this is a company that supplies and designs chips that automotive companies use. So I looked at the SPLC function on the terminal. Toyota, Tesla, and Apple are among some of their customers. And so after the pandemic, a lot of these automotive companies bought a lot of supplies and they had an inventory glut. So now the companies that are supplying that material are kind of needing to kind of pull back just how much they make. So that's what we're looking at when we see these earnings. EPS and sales beat estimates. The revenue beat estimates, but it was down 19% year over year.
And you wonder how much of the strike, the anticipated strike, might have caused some of the customers to, order a lot more in advance, thinking that there would be some interruption there. So this is not really a company that gives us much of a read on the whole AI data center side of the chip space, does it?
I would say it's more a macroeconomic read. I mean, you look at what their transcript said. They said that the demand environment remains muted with ongoing inventory digestion, slow end demand. For the full year 2024, we don't expect meaningful market growth as third-party reports would suggest. So those are the words from the company itself. But overall, the street was basically positive. I mean, the stock is trading higher today.
It gets to the idea, though, too. I mean, we talk about a stock that's been underperforming for most of the year, a stock that has, at least optically, seemed to have sat out the AI hype, if you will. But this idea that they are still tethered to an industry that is doing better than thought with regards to the automotive industry. And that seemed to be a big source of their weakness in the third quarter. But if you believe the strong results we got out of GM, the strong results we got out of Tesla, and maybe potentially the strong results we get out of Ford a little bit later, I would assume that might pose something better for this company going forward.
Yeah, their revenue that they projected for the fourth quarter was, I guess you could say, a little bit better than estimates. They see 1.71 billion to 1.18 versus estimates of 1.78.
Yeah.
So a little bit of optimism, but I still would look at the, what they were saying about the inventory demand on the call.
Well, they're definitely being muted when they could have been a lot more bullish. But
do you think they should change their ticker? Because I now feel like it's on running. Every time like someone's like mentions on semi on running, I always get them confused. On is on running.
Yeah.
On is on semi.
I know. But people also say on cloud.
These are the serious questions, Emily, that we need you to answer here on this program.
Emily Garfeo of Bloomberg News, thank you so much. All right, we're counting you down to the closing bell.
But I think what we know is that for fiscal year 25, which has just begun, the Treasury is probably in a pretty good spot with its long-term auction sizes, but that the closer we get to August, November next year, as you sort of quoted from Ed Yardeni, there's a strong likelihood that Treasury will have to resume its increases to long-term auction sizes.
Jay Berry, who runs global rate strategy over at JPMorgan, he kicked us off to the close just about 10 minutes ago, a conversation here about the potential for bond vigilantes to rear their head here, of course, coming off of the Treasury announcement earlier today here about their estimates of borrowing needs over the next quarter and a half.
Well, they're rearing their head today with Treasury yields moving higher, and the sell-off kind of continues, and it's been going on for a while here. But really, there's a lot of activity here across equities as well. I've noticed that utilities have been a consistent outperformer here in the second half, and they continue to outperform on a day like today as well.
I want you to remember this time, Scarlet Fu, because I don't think there's any other point in our career where we're going to be talking about the outperformance of utilities and the way that they have. If you came into 2024 and you said utilities were going to be the outperformer, leading every other sector in the market, I would have said you were crazy.
Or you'd be like, oh, this is a bear market, but it's not a bear market,
no,
right?
It's not.
And I mean, it's very much a frothy market in some people's eyes, especially with tech, doing really well. Big earnings week this week. We're going to be breaking it all down.
Yeah, absolutely. Here you see the outperformance on the Russell 2000. But of course, before we get to some of those small cap names, a lot of big cap names are set to report this week. That includes Amazon, includes Meta, and includes Microsoft, and quite a few others. Holly MacDonald joining us right now to continue counting us down to the close. She's Chief Investment Officer at Bessemer Trust, joining us here in Studio 2. I was just going through the numbers here. You have something like 190 S&P 500 companies reporting this week, pretty much all the ones that really matter. And that's really going to shape, I think, people's perceptions about this rally, assuming this rally is still going. What have we learned so far, Holly, out of the earnings season so far?
Yeah, well, Romaine, I'd say so far so good with earnings season overall. We're seeing the beats about in line with historic trends and really pointing to continued growth in the economy overall. It doesn't look like a recession is anywhere in sight. So assuming that I think it's about 45% of the S&P that's reporting this week, assuming that story holds, then I think it's more the nuanced stories. How much demand for chips are we seeing? What kind of spend are we seeing on the back of that? And I think some of the related areas, speaking of utilities, we're seeing some unexpected beneficiaries of AI spend, like utilities. And so any nuances on those stories, I think for our internal portfolio management teams, that's really where the focus will be.
So, well, with regards to AI? Or just overall?
AI and spend overall.
Well, let's just break out AI from that as well, because we ask everybody, like, kind of, where are you investing in that AI space? And you can't say NVIDIA and you can't say Microsoft. It's got to be somewhere else, right? Like, there's got to be more to AI than just those two or three companies.
Yeah, those are two big ones. I'd say one that's maybe less common, Broadcom, that's really helping a lot of the hyperscalers build their own chips and have more customization there, and they're really benefiting from that. And I'd say just a huge and growing demand set there. Still a fraction of the size of NVIDIA, to your point, so a lot more upside.
When you look at all the spend that these companies are doing on AI and AI-related businesses, is there a cycle here? I mean, can you chart where we are in the cycle?
I'd say we're still in early innings, Scarlett. It's hard to map it out when we're in a new unknown territory, but it's still fairly, in our view, again, still fairly early when you think about the secondary applications. I just know even within our investment team, we're seeing a big pickup in productivity related just to some early experimentation with AI. So I'd say many, many years to come.
And on that idea, there's been a lot of talk about how we're in the late stage of a business cycle. But Jason Trenner of Strategas points out that years of quantitative easing and deficit spending has really short-circuited that idea. So conventional business cycles may not exist the way they used to. And as a result, certain investment styles like value or small cap don't quite work the way that you expect them to.
Yeah, so I think with that, we should be somewhat humble in that this cycle, which let's say began as we were coming out of the pandemic, has been highly unusual. We've seen more government spend than we've ever seen. We saw interest rates at zero. We saw a full economy reopening and more stimulus coming. And so I would agree with the idea that you can't just take a historic business cycle and throw it on top of this situation. We're really spending more time in terms of what we're seeing in the actual data, the actual economy, and that's where earnings become really important, more so than I'd say historical models.
So based on what you're seeing, that gives you the confidence to stay overweight equity, and Bessemer is overweight.
We are overweight equities. We have been for some time. And I'd say overall, the backdrop is largely playing out as we anticipated, with growth slowing at the margin, but in a very controlled and contained way. And that's really enough for equities to continue posting gains. When you think about a Federal Reserve that has cut, will continue to cut. And if we're wrong on growth and things slow more quickly, they can cut a lot. So that's an asymmetry in their policy, which I think is a really important part of our outlook and being more constructive.
But based on what we've seen out of the economic data, this is giving a lot of people pause when it comes to rate cuts, saying that, look, we still have a relatively strong economy, strong enough that the Fed may not need to cut 3, 4, 5, 6 times, whatever was priced into this market. Do you think that pace of rate cuts is, if not on pause, going to be slower than what the market had priced in?
So it's about 5 cuts that are in the market now. I think that's about right. It could be a bit more. I would say that it's more about inflation having come down and being in a controlled, let's say close to the Fed's target, not exactly. That's what's really giving them room to ease, because their policy, I think on a real basis, is restrictive. That's not needed, even though the economy is hanging in there pretty well.
So on election night, we're curious to hear what you're going to be paying attention to, what security or asset class you think will perhaps be most sensitive to any of the results that come, leaking out early on in election evening. Yeah,
so Scarlett, so far it seems like the Treasury market has been the most responsive. But when we look at pricing and options markets in particular, that's where we seem to have seen more activity. So that may hold. It's hard to say that there's a big risk on or risk off with what we know right now in terms of a pretty tight election. But I would be watching the dollar, treasuries, I think especially emerging market currencies and equities, and just the broad futures market. But I'll really be focused on what are we hearing from the presumptive president in terms of an acceptance speech, whether that's that night or in the couple days. What are their true priorities that may be different from what they've campaigned on?
And at what point did you kind of set your portfolio for this election outcome, and you're just kind of waiting to see how it all pans out? Or is that something you're still tweaking right now?
I'd say for the most part, we're focused on where can we structurally compound capital through an economic cycle. So it's much less responsive to the policy environment, more tweaking things at the margin as needed as different risks emerge. But with a pretty constructive backdrop, and I'd say importantly, a lot of these structural trends that are quite independent of the political cycle, whether it is AI, whether it's cybersecurity spend, healthcare innovation, things that are going to continue regardless of who's president. So the modifications are pretty minor.
All right, Holly, great stuff, and great to have you here on the big program. Holly MacDonald, Chief Investment Officer over at Bessemer Trust, helping us count you down to those closing bells. We're just about 2.5 minutes away. Stocks not far off session highs, at least the Russell 2000 holding near those session highs, though the NASDAQ right now, composite dipping into the red.
Yeah, and there's a lot of big NASDAQ companies reporting, but of course in the next 10 minutes or so, we're going to be hearing from Ford, which will kind of set the tone as well for the industrial companies.
Interesting to see the VIX down, yields up. A full breakdown of all your market action right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're taking you through the closing bell with a global simulcast that starts right now. Carol Massar and Tim Stenovic joining us from the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership here with YouTube. A big rebound here in the equity markets, Carol Massar, though very much heavily weighted towards small and mid-cap stocks.
Yeah, kind of interesting, right, to see that trade. I've been thinking, though, a lot about the energy trade. You had crude oil went down more than 5%. You've seen energy names lower. But what has rallied off of that is your cruise line names, your airline stocks, anybody who taps into the energy market, which is kind of a big line on the balance sheet, that energy cost. They have definitely been benefiting in today's trade.
We're kind of talking our gainers and decliners here, because I got to tell you, kind of tough to find decliners, but look no further than energy to find decliners. The worst performing sector in the S&P 500, all tracking this drop in Brent after those Israeli strikes against targets in Iran avoided those crude facilities.
Yeah, absolutely. And I was thinking as well, with oil prices plunging, how that kind of removes some of the inflation fears that, had taken hold in this market. But I feel like the Fed is kind of the last thing on people's minds, at least for this week.
Yeah, absolutely. And thankfully, they're in a quiet period, so we don't need to worry too much about them. But this is kind of the 1-2 punch, right? I mean, 1-2-3 punch, if you will, here with earnings really heating up this week, the busiest week of earnings. That's going to be followed by more earnings next week, the election, then, of course, the Fed decision on a week from Thursday.
It's a lot coming out of investors. 42%, right, of the S&P 500's market cap coming your way in regards to earnings. So it's a big one this week.
Absolutely. And we get the closing bells here in New York. You can take a look there at Walmart actually ringing the bell. They're on the NYSE floor with stocks pretty much green across the screen here. We're up about 0.3% right now on the S&P 500, about 0.7% on the Dow Jones Industrial Average, while the NASDAQ Composite holding on to the gains of about 0.25%. We should just point out the NASDAQ 100 right now looks like it's going to close out the day unchanged after spending a good portion of the session in the green. But let's go to your outperformers on the day. That includes Dow Transports up 1%. S&P 400 mid-caps up 1%, and the Russell 2000 up 1.6.
All right, going back to the large caps, the big caps, the S&P 500, most names in the index higher today, guys. 355 to be exact, 148 to the downside, Scarlett.
All right, let's take a look at the industry groups. You have 9 out of 11 groups in the green, so a lot of green on that pie there. Financials leading the way, gaining more than 1%. Materials and utilities are the next best performers, and the red spot there really belongs to energy, down 2/3 of 1% as oil prices tumble, and tech slightly down.
All right, guys, to the individual gainers we go, and taking a look at Trump Media and Technology Group, up pretty much closing just off its highs of the session, up more than 21%, extending a 5-week surge that has put the stock up some 270% from a September 26 low. We had a lot of retail traders out there touting the shares, betting markets like Polymarket on Trump returning to the White House, and so those increased odds. There's a lot of conversation, certainly on social media, and as I said, the retail trade, so really pushing that name up. We mentioned the pullback in terms of oil prices, and so you've seen a lot of travel names, transportation names higher in today's session. That included Carnival Cruise, up nearly 5% in today's session. And then I do want to just mention Dow Jones Transports, because you had most names in the index higher today. The index overall up about 1.2%. Quick check here on the index, and you had 16 of the 20 names higher in today's session, again, as we've seen that restrained response from Israel against Iran, and that has put some pressure on energy prices. Okay, so let's talk a little bit about some of the decliners, including energy companies. I'll get to those in just a second. But starting with Boeing, shares fell after the company launched nearly $19 billion share sale. It's one of the largest ever by a public company, offering to sell 90 million common shares and about $5 billion of depository shares. That's according to a statement that came out today. The common share portion alone would total just under $14 billion. Shares of Boeing falling today by 2.8%. Could raise up to about $22 billion, according to Bloomberg calculations. And on to one of the energy companies I want to focus on, APA Corporation falling 4.5% today. We mentioned why oil fell, and we saw oil companies move as a result of that. The S&P 500 Energy Index dropping as much as 1.9% in the session, hitting its lowest level since October 1st. It was the worst performing, as Scarlett mentioned, of the 11 sectors
in the market. APA led those declines today, falling 4.5%. And finally, GE Healthcare Technology today fell 2.8%. We saw weakness as a result of Philips shares plunging the most intraday since September of 1998. The medical tech firm reported third quarter sales that missed expectations. It also lowered its comp sales forecast for the year. We saw GE Health shares fall in sympathy there.
All right, let's take a quick look at yields up again for another day here. Fifth session in the past 6, where we've seen yields move higher, defying a lot of expectations that we were going to see a much more meaningful drop. In fact, on that benchmark 10-year yield of 3 basis points today to 4.27, that's the highest level going back to late July. Similar story for your 2-year yield, up about 2 to 3 basis points on the day, but again at 4.129 and change. That's the highest level since at least August 1st here, and that is the trajectory right now, and it's a big part of the reason why we kicked off the close here on Bloomberg Television a little bit earlier with a big focus on those Treasury yields and Treasury borrowing.
All right, guys, as we wait for some earnings after the close today, I want to get to one that's going to actually report earnings tomorrow. We're talking about Crocs. This one has been on a tear this year, up about 48%. Well, you know, what's interesting is, as this company has focused on a younger generation to wear their shoes, it turns out schools are kind of pushing back, and they're starting to ban. Dozens of schools in at least 12 U.S. states have forbidden students from wearing Crocs in their day-to-day use, and their concerns are that students are tripping and falling.
It's not just tripping and falling. Other schools have say the shoes have led to a rise in accidents and distractions, students playing with the little charms that go with the shoes in class. They have thrown shoes at classmates before.
I'm sorry, this is separate from Crocs now at this point then, right?
No, I mean, I think you throw a Croc because maybe it wouldn't hurt as bad if it hit you. But
again, bigger issues.
There's also
right.
Julia Fenzeris wrote this story. It's a great piece. There's a scary anecdote in here about a young person actually getting a shoe stuck in an escalator.
Ooh.
And then getting a pretty severe injury as a result of that. I don't know if you guys are.
That could happen with a lot of shoes, though. A shoelace could get caught.
Yeah, that's true.
I don't understand, though. Is this different from just regular shoes?
Yeah, the argument from these school nurses is that they're not as safe as a traditional regular shoe.
Okay.
Yeah, not as safe as, the New Balance.
I feel like this is the 2024 version of when I wasn't allowed to wear Keds sneakers during gym class because everyone took out the laces and it wasn't really a sneaker.
Well, and I guess if you don't put the strap on the back, I remember clogs being banned like in grade school or something because people were tripping and falling or something.
They call it the safety strap, Carol.
Oh, sorry.
No, I just thought it was interesting that there's a safety strap on a Crocs.
Maybe there's a problem to begin with. I'm just going to say.
All right, we do have some breaking news here. Let's just start off here with Ross Stores as we wait for earnings across the wire on forward. A new CEO over at that company. We knew they were looking. They've now found one. James Conroy is going to be the new CEO at Ross Stores. That's just crossing the wire right now. This will take effect on February 2nd of next year as Barbara Rentler steps down.
Boot Barn Holdings CEO. He's coming from Boot Barn, so he's stepping down from Boot Barn, going over to Ross Stores.
Can you say that again?
I said it once. It's enough.
Boot Barn.
Boot Barn. Yeah.
Boot Barn. All right, what do you guys got for us?
There's a story about, hold on, let me just pull it up because it was a really good one, about JPMorgan warning people that there's going to be a water shortage because of AI power demand. Obviously, to keep data centers cool, you need a lot of water, and that is going to collide with less reliable precipitation patterns due to climate change. If you're in the East Coast or in the New York area, it hasn't rained here for almost a month, which is kind of unusual for this time of the year.
Makes me feel like we're home. Makes me feel like California.
Oh, yeah.
I've been wondering.
For better, for worse.
Yeah. Here's a stat. Large data centers can use as much as 5 million gallons of water a day. That's a lot.
All right, let's get to earnings here, as quite a few are crossing the wires that we need to get to. VF Corp, the owner of North Face, reporting operating income in the most recent quarter on an adjusted basis of roughly about $273.9 million. That's above street estimates of $219.5 million. And the company also saying that its revenue from continuing ops basically coming in right in line with estimates. EPS also a slight beat. The shares higher, Carol, up about 3%.
All right, guys, let's get to another one crossing Cadence Design, and let's get right to the outlook. Fiscal year adjusted EPS of $5.80 to $5.93. That is it had seen $5.77 to $5.97. Fiscal year revenue $4.61 to $4.65. It had seen $4.6 to $4.66 billion. And I'm just taking a look. Stock investors seem to like it, at least at first blush. Stock is up about 8.6% here in the aftermarket.
All right, I'm looking at shares of Ford, which Welch are bouncing around but higher in the after hours. The company sees fiscal year adjusted EBIT coming in at $10 billion. They saw it from $10 billion to $12 billion. The estimate was for 10.6, so that came in a little light. Third quarter adjusted EPS, though, coming in line with expectations at 49 cents. Shares now down about 1%.
And this is a stock that's fallen almost 10% this year. And since its last earnings, down 18% because of that higher than expected surge in warranty costs. A lot of eyeballs on whether it's going to turn things around on that side. Another headline that just crossed in terms of its outlook for Ford Blue, which is its traditional ICE vehicles. EBITDA will be $5 billion for the full year. It had seen $6 to $6.5 billion. So that is a downgrade on its outlook for its biggest business.
And it's kind of interesting, too. I mean, just real quickly, guys, because there's a lot in this here, and they really do talk about this idea of cost controls as that being the big driver going forward for what those earnings are going to look like. The company saying that it has a lot to share, not just in the release, but on that conference call as well. We're going to continue our coverage on Bloomberg Television in just a minute.
Yeah, and that forecast in particular, Romaine, dragging down the stock down about 4% here in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
A lot of activity right now in shares of Ford. A deeper dive here behind one of America's largest automaker. That's coming up next here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Stocks higher across the board here on this Monday afternoon. And S&P 500 up fractionally on the day, but the real outperformer, you're going to find that in the mid and small cap space with Dow Transports, S&P 400 mid caps, each up about 1% on the day, while the Russell 2000 adding about 1.6% here, even as yields continue to rise. There's a lot of concerns right now here, not so much about economic conditions, but almost the inverse, the idea that stronger economic conditions might keep the Fed at bay. At least for now, though, that puts the focus back on earnings.
Yeah, and earnings is the focus as we take a look at some after-hours movers, starting with Cadence Design. Cadence Design Systems up about 8% right now after the software maker reported better than expected results. It narrowed its full-year adjusted EPS forecast. We also have big gains in VF Corp, which is the owner of North Face as well as Dickies. That company's stock up about 9% after hours trading after its second quarter adjusted EPS also beat analyst estimates. And Ford is the outlier here, Romaine, down about 4% right now after it has trimmed its profit forecast. A slow EV ramp, quality issues continues to be a concern like we had seen in the second quarter. In fact, for the EV business, Ford Motor E, it sees a loss for the full year as well. So that is something that we'll discuss further.
Yeah, those losses continue there. As far as the third quarter here, adjusted EPS pretty much on the nose at 49 cents on the back of about $46 billion in revenue, up about 6% on a year-over-year basis. And going forward, as she says, looking at the full year, Ford talking a lot about costs. David Welch joining us right now, our Detroit bureau chief, to help break down these earnings out of Ford. And I do want to start looking a little bit forward, David, rather than looking backward at the most recent quarter and some of the costs and, more importantly, the losses that we're still continuing to see in some of their businesses, including that EV-related business.
Yeah, look, they said they were going to lose $5 billion on the EV business this year. I think it lost $1.2 billion in the quarter. And I think the problem here is there's nothing really in this report that says they're getting that under control. The earnings they're talking about for the year looks like within range, but at the bottom end of the range, they were talking about earnings before interest and taxes being as high as $12 billion. Now it's coming in maybe closer to $10 billion. That tells you that these things like warranty costs, losses on electric vehicles, they just don't quite have a handle on that yet to the point where they can give stronger guidance going forward. So, I think that's what investors were really looking for. Whereas, with General Motors, you had a quarter where they were at the higher end of the range, and they also had cash flow forecast that was above the previous forecast. All of that says that they're going to keep buying shares back and that they're operating the business well. And Ford's still trying to get a handle on some of these issues that investors were really keying in on for this report.
So let me ask you about the warranty costs, because they're an issue in the second quarter and they're still trying to get them under control. Like you said, are these tied to EVs or to the ICE vehicles business?
It's the whole thing, but really it's the internal combustion engine business, because they don't really have that many electric vehicles on the road relative to the ICE vehicles that it would be driving these kinds of costs. So it's just up and down the business that they need to rein in the quality problems and get warranty under control. It's the basic blocking and tackling of the auto business, and it's really been a struggle for them to get this thing nailed down.
I am curious that when we kind of move outside the world of just the EVs and these renewable energy vehicles, I mean, how is the Pro division doing? Because I know on the last conference call, they seem to really tout this as being one of the more stable areas of Ford right now.
It is, and it's a real strength of the company in the U.S., and they do very well with commercial vehicles in Europe, too. So, look, that's sort of a good, stable business for them. They're great at selling trucks. They've got a good commercial van business as well, and so look, that's something they can pretty well rely on. It's just it's the other core part of the business, the retail business, where they're having the quality issues. And EVs is they don't have a dedicated platform where they can really get scale. Like selling more of them just loses more money unless they can really get costs out and start to redo how they engineer those vehicles.
So, David, when you talk about quality issues, and you've been covering autos for a long time, how long does it take for a car maker to fix that, to turn that around? I mean, it's not a 1 quarter thing, and it looks like it's not a 2 quarter thing either.
That's right. It's so kind of deep into the vehicles themselves. It's usually, sometimes you have a big recall or some other crisis where it's one particular thing with a vehicle where you stop the sale. GM's had a few of these with the Chevy Bolt years ago, and they even had it with some of their current models with software, and they just stop selling them until they get a fix, and then they spread that fix throughout the lineup and they get it back on the road. And it's not like Ford has had one big monster recall like we've seen with other companies. This is just kind of problems here and there where it's warranty sort of across the board. And when that's the case, you're looking at different parts, you're looking at processes, and you're trying to just get a handle on why you keep having these warranty issues that cost the company money. And it's a gopher hunt.
It's a gopher hunt. That sounds like it takes a lot of time. David Welch, thank you so much. Bloomberg's Detroit Bureau Chief Dave Welch giving us the instant analysis here on Ford's results. And, when you hear about things like warranty issues, Romain, I know you were in the market for a car not so long ago. Like, that makes you, as a potential car buyer, really hesitate before you look at, a company that has that.
Yeah, absolutely. And I mean, there were a lot of factors that in this car buying process that I probably wouldn't have paid attention to, 5, 6, 10 years ago. But it becomes much more layered here. And you are making a decision not just about the car itself, but also about the company, because we were looking, and not to just pick on Ford, we were looking at some of these newer companies, of course, these newer EV companies, and we're like, do we really want to hitch our wagon to a company that's maybe a little unproven, or do you want to hitch your wagon to maybe an established company that might be going through some issues?
Yeah, absolutely. Yeah. I mean, the reviews on how the service, the after service goes, it's critical, because that's time at the end of the day, right? Yeah. I mean, you get the deal initially, but then there's the cost and the follow-up that the whole thing, having that car requires.
Yeah, this is why you just drive a car for a year, get rid of it, and get a new one.
If we could all do that. All right, coming up, we're
not very ESG friendly.
No, sure. Not at all. Quite the opposite.
Do what you gotta do.
We're sticking with Ford results. We're going to break down the overall auto industry as well with Lauren Fix. She is founder and automotive expert at Car Coach Reports. And you're seeing Ford shares now down about 3 3/4%. This is the close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Worth getting out of bed this morning.
The employment outlook, it's been bullish. People are good.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
How dependable is this data?
People want to know the outcome of the U.S. presidential election before they start maybe moving jobs. And guess what? The Fed has to make a big decision based on this data.
The October Jobs Report, Friday on Bloomberg.
We're keeping an eye on shares of Ford, which are down right now in after-hours trading following results from the automaker. Ford losing about 4 1/4% right now after it cut its top end of its full-year earnings forecast. For more on Ford and a deeper look into the auto industry overall, we want to welcome Lauren Fix. Lauren is founder and automotive expert at Car Coach Reports. Lauren, when it comes to Ford, we know that the car maker has been struggling to cut costs and overhaul its EV strategy, and in particular get its warranty costs under control. That was a big issue in the second quarter, and it looks like it remains a big issue now. What does it mean when a car maker like Ford is dealing with quality issues?
Well, quality issues depend on what those qualities are. I mean, there's some issues like it could be a door latch not latching or a programming issue, something that's a recall, just like the airbag recall we've seen in the past. Consumers as a whole don't necessarily hear about that, even though you're talking about it and we talk about this on a regular basis. Consumers go by price, and that's a huge factor for them, so they're looking for deals. If there's incentives, that's going to more convince a customer to buy it, even though they may hear about a quality issue and it can be fixed. They typically just bring the car back to the dealer, get a loaner, and they move on, where you and I look at it from a completely different perspective.
Right, and the quality issue is costing Ford quite a bit, and it's showing up in all of its different forecasts, and it's forcing it to make lots of other decisions, including the struggling EV business, where it still sees a loss for the full year of $5 billion. What is it about the Ford EV business that's proving to be more difficult than it anticipated?
Well, they're certainly not on the same platform. I mean, they're fighting against Tesla, which is the leader in the EV business. The number one selling vehicle for the third quarter was the Cybertruck, followed by the Model Y, and the Mach-E came in third. Even with price deductions and incentives on the table beyond the $7,500 tax credit, they're still struggling to make sales, and every single Lightning truck as well as Mach-E, they're taking a loss on those vehicles, and it's going to take a long time to recoup that. And in the position that they're in right now, they're offering chargers for people's homes. Again, that may or may not increase the sales, but they're still struggling, and actually every brand is struggling with electric vehicles.
Well, that's what I'm curious about, Lauren. When you look at it broadly here, what is kind of the demand picture for EVs? It seemed like we had this big ramp up, and then everyone was anticipating that there was just going to be this huge onslaught of buying. That petered out pretty quickly, and I don't know if that was a function of the lack of cars available or the price of those cars or the infrastructure. What's holding us back from more adoption of EVs and other alternative fuel vehicles?
Well, I don't believe it's a lack of choices. Every brand is making an electric vehicle, literally. And so the choices come down to when you choose that vehicle and you look at the insurance costs, they're super high. You've got to have a charger in your home, or you have to use public charging, which has always been a challenge. If every car was electric, we know that they couldn't support every single vehicle being electric. Although there's a lot of push from the federal government with the $7,500 tax credit, that's all changed now. That vehicle has to be built in the U.S., and a lot of brands only get it with a lease. And everybody's increasing their prices, including Ford. I noticed that with a couple of the vehicles that I've looked at recently where they've gone up $10,000. That's a lot of money for the average person. And when you start looking at that over a 2-year period, you start looking at all your options. Consumers really like hybrid. You get the best of both worlds, whether it's a plug-in hybrid, you can plug it in, drive on electric, or something like a Toyota Prius, where you can drive on electric if you want, and after 30 miles an hour, it goes on to gas, and it gives you the range that people want so they can have one vehicle to go on vacation, rather than having an electric car and then also having an SUV that has gas power. And so this gives them a combination. The only brand that has not gone onto the hybrid route is General Motors. They believe in what they call coexist, which is a gasoline-powered vehicle or an electric. They're not going to do hybrids, they claim right now. But every brand, including Volvo and Jaguar, have looked at hybrid because they realize that's what consumers are demanding.
Absolutely. And I should just point out here, I mean, we bought a new car in our household about 3 months ago, looked at EVs, looked at gas, and of course ended up with a hybrid, like a lot of other folks here. I am curious going forward about this idea of affordability. I know interest rates have played a big part in that, but let's face it, the pricing that we saw from automakers, whether it was on EVs or even the gas vehicles, has been pretty aggressive over the last couple of years. Are we going to see an attempt, and I mean a sincere attempt, by some of these automakers to provide more affordable models in their lineup?
Well, I think they're all trying to. I mean, now you've got Tesla coming on board with their new discounted vehicle, which is going to be, we don't know the exact price, but somewhere around the $30,000 range. And that's going to be a big impact because Tesla literally owns the electric vehicle marketplace. Every other brand is struggling to keep up with them. There are vehicles out there like the Hyundai Kona EV. You can get that for a reasonable price, but the average cost of an electric vehicle is $66,000, where the average price of a gasoline-powered vehicle is $50,000. So that difference is enough to deter people to go away from it. Now, the election's going to be a huge impact. If if President Trump gets elected, well, he already said there'll be no mandate, but he likes to have a mixture. If Harris gets elected as president, well, then she said she's going to go push that electric vehicle mandate. There's a lot going on behind the scenes, including union fees that have gone up. So there's a lot of costs, and that's why Ford's trying to cost cut as best as they can.
All right, Lauren, really appreciate your joining us. Lauren Fix is founder and automotive expert at Car Coach Reports. And I think the question you asked about affordability is an important one, especially because there are a lot of used cars available now, especially used EV vehicles. A lot of people talking about buying Teslas from Hertz, which is trying to, reduce the size of its fleet. And also a lot of people are leasing EVs, then they're going to end up having to return them, and that's going to be available for sale.
Yeah, it'll be interesting to see the price mix. I mean, we've seen the incentives being offered on new vehicles and, of course, some of the discounts that you get by buying used here. But it's still like, I mean, if you look at price points, I mean, she said the average, did you catch what she said? The average cost of a new vehicle?
Yeah, $66,000.
Yeah, and then 50 for the gas?
Yeah,
I mean, I know I'm going to sound like an old man, the old days, where, I paid
back in my day,
10 grand for my first car, but,
Okay, that's long gone. Coming up, McKinsey's out with a report on the top industries for growth and dynamism.
Some of the industries that keep our global economy going are set for gangbuster growth and sharp competition. McKinsey calling these industries arenas and says there are 18 we should be paying attention to. Everything from semiconductors to electric vehicles. Joining us now to talk a little bit more about this is Kweilin Ellingrud. She's director and senior partner at the McKinsey Global Institute, and she joins us here in Studio 2. Great to see you, Kweilin.
Great to be here.
Let's talk about, 18. We're not going to get to all 18, but let's start with a couple of the big ones that we know investors have really been focused on. One of those is electric vehicles. Exactly. And even though the adoption rate has slowed a little bit, almost everyone we've spoken to on this show says this is just a minor speed bump. And at some point, that ramp up that everyone has been anticipating is going to come to fruition. Are you seeing the same?
We are seeing the same. In fact, EVs is one of those arenas that was an arena shaping the last 20 years and will also shape the next 20 years. Cloud, same thing. Semiconductors as well.
When you talk about it shaping, let's just stick with EVs and arena. Like, what are the ripple effects of that? It's not just you and me buying a new car. There's more to it than that.
No. I think when we say shaping, it's outsized growth, right? So we think these arenas, 18 particular industries out of roughly 60, are where all the action is. You've been talking about, today earnings reports. This is where all the action is going to be in terms of profitability, higher revenues. These arenas are more global in nature. They're also faster growing and have much more dynamism, so more gains and losses of market share within each of these industries.
Is profitability a required component here? Because for a lot of these car makers, their EV business is not making money.
It's not. I think the two criteria we looked at to define an arena, one was growth in terms of revenues and kind of relative share of the overall economy. And the second one was dynamism, what we call a shuffle rate. So how is market share shifting? So you could have high shuffle rate or dynamism, but also low profitability. But you do need a large market size.
So when it comes to incentives or government support, at what point of the cycle do you actually see these arenas in? Are they at the point where the government subsidies helped build them and nurture them, or do they grow to a point where the government and other entities come in and see, oh, wait, we need to plow more money into it?
Yeah, I think different arenas are at very different stages of maturity. One of the big factors that will affect how arenas grow is geopolitics. And so the geopolitics, the political kind of rules and regulations will certainly determine that. Another big factor that will affect arenas and their pace of growth is also AI adoption that we've been talking about today. So lots of different factors driving either accelerated growth. Net zero would be the last one. We've been discussing EVs.
Yeah.
How quickly we go there and which path will determine pace of growth.
So these are structural kind of secular themes that have kind of been afoot for a while. But in your report, you also talk about some new arenas, if you will, that are kind of emerging. Three that you singled out here are autonomous vehicles, which kind of ties into the whole EV discussion.
Yes.
The business of space, which is huge, at least here for us at Bloomberg.
Indeed.
And modular construction. Talk to me about the business of space, because when I hear about the business of space, I only really hear about a couple of big companies now in this area. Is that going to broaden out beyond just, say, SpaceX, AST, and I guess some of the legacy companies like Boeing?
Yeah. We think it will broaden. I think that's why it's an arena going forward over the next 20 years. And what usually defines an arena is kind of three ingredients. So it's a change in the business or technology. So very much in the kind of case of space. It's escalatory dynamics in investments, so higher and higher capex required. We see that very much in space, but in many of these other arenas as well. And then a large market size. And as we progress and it matures, we'll see that as well in space.
You mentioned something else, which is that arenas are largely a Pacific phenomenon. What does that mean? Does that mean that the companies are based there, that the supply chain is based there, that the talent is there, or the funding has to come from there?
We see arenas primarily concentrated in the U.S., where about 65% of the market cap of the companies in arenas of competition are based, and then another 20% in China. So we see a little bit in Europe, but much less, right? It has fewer of these kind of larger giants in these emerging arenas of competition.
Do you think there is going to be an interconnectivity in the development of this? I mean, you point out the idea of geopolitics, and yes. We live in a world that's changing a lot. And when you go back to the big tech boom that came out of the 50s, 60s, and 70s, the internet boom, there was an interconnectedness to this globally in the development of these industries. This seems different this time, particularly when it comes to AI, semiconductor chips, even things like EVs, a lot of protectionism that I feel like is going to sort of wall off certain countries, or at least certain regions of the world.
Absolutely. I think that could slow down the development and pace of both revenue growth and profitability if there's sort of two separate markets or separate technology. But regardless of geopolitics, we think these 18 arenas of competition going forward, out of roughly 60, will be where the action is and where the profitability is.
What's the most underestimated or overlooked arena that you think we need to be following more? Very quickly.
Probably nuclear fission and its role in net zero.
All right, great stuff. Kweilin, thank you so much. Kweilin Ellingrud is Director and Senior Partner at McKinsey Global Institute. All right, let's just give you a recap here of some of the earnings that have come out during the after-hours trade. We have VF Corp, which is, of course, the retailer behind Timberland and North Face, rising in the after-hours trade by 16% after reporting EPS that beat analyst estimates for the fiscal second quarter. And then you have Cadence Design Systems, which is a software company, Romain, narrowing its EPS forecast for the full year. That stock also up quite a bit. Ford, though, was the big disappointment here.
Yeah, I mean, the Cadence design, though, was a lot better than it sort of looked under the surface. And you talk about the beneficiaries of the AI boom here, of course. I mean, when you go into some of these plants, TSMC, ASML, everything else, I mean, there's software that's running a lot of those systems belongs to Cadence here. So potentially they stand to benefit from that, assuming that this continues.
This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Stéphane de la Faverie, the longtime executive at Estee Lauder, set to take over as CEO, according to the Wall Street Journal. And the cosmetics giant may actually make the announcement formally later on this week.
Yeah, this is interesting. I mean, we've seen a lot of sort of ructions atop some of these big sort of legacy luxury brands, if you will, here. Some of that is just the natural churn that you get over time. Of course, trends change, and so you need new leadership as well here. But of course, Estee Lauder really never really quite recovered from the shutdowns that we saw during the pandemic, which just really hit a lot of their business. Obviously, a lot of their business tied to travel, tied to airports, tied to China. So maybe he can bring a little bit, I guess, new life back into this company. Not that they're struggling too much, but certainly need a turnaround.
They just need to course correct.
All right. Well, speaking of executive transitions, someone's going out the door. John Corrill, he was the real CEO. He's now exiting after less than 2 years on the job here. Now, they weren't, of course, didn't go into specifics here about why here, but
maybe he wants to spend time with his family.
But of course, the Real has been certainly struggling, or certainly their stock has been as well. This idea here that the business model of basically, I guess we'll just call it what it is, thrifting more or less, but just kind of in a more high-tech way, has been somewhat challenging. I mean, it's very high. There's a very high cost associated with this to get all the goods, verify that the goods are what they are, and then of course resell them here. So maybe the search for a new CEO and a permanent CEO will help them write those costs.
I like how you put it, thrifting. You shop at a different price point than I do.
Yeah, I mean, that's thrifting, right? Isn't it? It's just used stuff, right?
It's super high-end stuff.
Okay, that's still thrifting. I mean, I don't know.
All right, that tells you what you need to know about Romaine. The third person we're watching is Tony Hoggett. He is Amazon's top grocery exec, but is leaving that company to join the restaurant startup Wonder, according to Fortune. He will take on the CEO position. We know that Wonder is expanding very aggressively. They're opening one new location per week over much of the next year.
I'm really interested in this, mainly because I saw this headline that he was leaving Amazon grocery last week. It was last Friday. And anytime you see that, it's like, where are you going? And we spoke with Mark Lorio, I think it was a few months ago, about the Wonder Ventures here. And I just walked past one here in Manhattan. It hasn't opened yet, not too far from my house, but they're constructing it here. It's an interesting concept. It's not quite a food court. It's not quite DoorDash, but it's kind of a combination of the two, except all the chefs in theory are either celebrities or at least somewhat well-known folks here. And every location is somewhat slightly different than the next, so it's not like you're going to get the exact same thing if you go to the Wonder that's in Lower Manhattan versus the one that's Upper Manhattan. So I don't know, interesting concept, and obviously you got a guy here in Hoggett who certainly has a lot of experience in this space. It'll be interesting to see what he brings to the table.
Yeah, and he also comes from the grocery space too, so you wonder if Wonder has broader ambitions as well down the road.
Yeah, you do wonder about that as well, and it changes a lot. I think the way that we buy food and order food, and and a lot of the transaction costs are related to it. And I don't know, you're not really. Are you like a delivery person or?
I mean, I'm old school. I'd like to just go to the store and pick it up because I don't want to pay the delivery fees.
Oh yeah,
because the delivery fees are like.
So a cheapskate is what you're saying.
Thrifty. Let's go back to thrifty.
Thrifty. That's our word of the day. Thrifting. All right. Well, speaking of celebrity chef startups, culinary company KZ Provisioning is teaming up with Aramark Sports and Entertainment, the award-winning food and beverage provider at stadiums across the U.S. Now, here's the thing. Let's get right to it. The two are joining forces to help fuel athletes, coaches, and teams' performance-enhancing meals. We had a chance to speak with two of the people behind that collaboration. That includes the famed chef Andrew Zimmern and the chief growth officer over at Aramark, Jerry O'Connor. Take a listen to what they had to say.
My business partner, Gavin Kaysen, went to visit a friend who's a professional hockey player in Minnesota and was down in the locker room when the post-game meal was being served. And what rolled out was absolutely the worst thing that you could feed a professional athlete after all of the exertion that it takes to play a professional game at that level for a full 60 minutes. And Gavin called me and said, there's something missing here. And wherever there's a problem, there's a great business. And as we dug into this, we realized that when it comes to food, when it comes to food wellness, when it comes to concepts of happiness and hospitality, things that in our restaurants we were as good as anyone else at, and when it came to quality of food, we were as good as anybody else at, we realized we had a tremendous opportunity. The one thing that was being done that would shock most people to learn, it shocked us, was that the most valuable asset that a sports franchise has is the wellness of the athlete, and the missing piece was food. They had all the performance training in the world, but the missing piece was food. When we added our hospitality layer, if you're a professional athlete on the road and you have a wedding anniversary, a kid's birthday, a 500th goal scored, a 1,000th game played in the NBA, when it comes to our NBA franchise clients, we celebrate that for the athlete, home or away. It's those little moments of hospitality that increase player happiness and comfort, and is a huge difference maker for us, along with the food that's designed for recovery, for play, for getting the most out of an athlete.
So clearly it's a very holistic approach. Jerry, what is the expertise that Aramark brings to this venture?
Yeah, that's a great question. I think the most attractive piece for us collaborating with Gavin and Andrew is it's a new point of differentiation for us within the food and beverage industry. Our space has become unbelievably crowded from a competitive perspective over the last few years. One thing that Aramark has remained keen on is staying true to who and what we are. And at the end of the day, the root of that is food and beverage and hospitality. And in conjunction with that, when we look at what the greatest asset is of these organizations, it is their athletes, it is their staff, but yet they're the only individuals that generally we don't have the ability to touch. So now to be able to create this collaboration that extends our reach into the fan experience to a whole other degree is extremely exciting for us.
I'm just curious, forget my ignorance, but are you going to be competing against like the private chefs that a lot of these athletes have, at least the ones that can afford it? I mean, you always hear about, they would hire these folks specifically to kind of get to Andrew's point, is to create meals that are obviously going to enhance their performance, but also be tasty as well. Is that competition for you or no?
I don't believe so, no. Yeah. And as a matter of fact, when we met with Gavin and Andrew from the start, I think back to the reach that they bring, it's that network, that Rolodex of the local national personalities that these athletes are looking for and having catered to them pre and post game. Yeah. Still having those touches with the expertise that Gavin and Andrew bring also.
What is the cost to the team, Jerry, and how does it compare to when they simply provided those catered meals after the game?
That's a great question. I think it really comes down to the root of the contracts individually. It's not a one size fits all. Every program is going to be incredibly different as well. Seeing that this is such a great asset and investment for most of these organizations, it's one that we want to be able to have an open dialogue to understand the degree of care that they're going to require on the culinary side to get to the point of a right contract.
And it's not a non-answer answer. Yeah. Every team wants to have a different set of meals delivered to them, different practice schedule, different number of players between an NHL team, an NBA team, a Major League Baseball team. So a lot of that is inherently part of the cost issue, right? You got to find out what the client wants. What we have found with our current teams is that we're about 7 to 9% more expensive, but our level of deliverables is about 25% greater. And when you talked before about off-season, I think that's another really great thing to address. Once you gain the trust of these players and they realize they're performing better, they feel better at practice, they're getting more out of it, every single one of them, they're professional athletes. The collegiate players at the big universities consider themselves about to be professional athletes. And all of them look downstream and say, wow, I'd like to be 30 and still signing a contract and not sidelined because of injury or because I only had 9 years in the gas tank. We can increase the gas tank. So the player trust has been absolutely off the charts.
Chef Andrew Zimmern there alongside Jerry O'Connor at Aramark Sports, a conversation that we had a little bit earlier here about this partnership here to feed athletes in a way that, at least according to them, is going to be a little bit more layered and efficient.
Yeah, and I love the story about how, they realized that this was a business opportunity because they would see the athletes and what they actually ate before game day and were horrified at the amount of salt that they were consuming and how, there was no protein and no nutrients in there.
Although some of the athletes, I think they prefer it that way. And some of them have this, when we asked them, I don't think we played the clip, but we asked them about this idea of superstitions as well, right? There are certain athletes that, they have to have a Big Mac or they have to have this beforehand. They don't care. It doesn't matter if it's healthy or not. It's just kind of what they eat as a way of sort of, getting themselves psychologically ready.
Right. But they'll do whatever they can to kind of ease that process. They were talking about how they brought in one player's grandmother from Norway to come in and have her show them what she does to prepare her grandson's meal, and they've mimicked that.
Yeah, she is the real MVP. All right, when we come back here, we're going to set you up for some of the potential market-moving events over the next 24 hours. Stick with us. This is The Close on Bloomberg.
8 days to go till Election Day, with both Kamala Harris and Donald Trump closing in on battleground states. Trump holding a rally in Georgia, while Harris made a push in Michigan, visiting a semiconductor assembly line a week after the company Saginaw was granted a $325 million preliminary investment under the CHIPS and Science Act. Now, securing access to chips has become a geopolitical weapon in the race between the U.S. and China. And joining us now is Sara Hsu, Clinical Associate Professor of Supply Chain Management at the University of Tennessee, Knoxville. Sarah, even though Saginaw was granted that money, from our understanding, a lot of the money that has been promised has not actually been distributed yet, even as the Biden White House is pushing for chip makers to build more factories in the U.S. Is this normal?
Well, we haven't had an act like this in recent history, so whether it's normal or not, it's not clear. But we do know that it's really critical for the companies to get the money soon. Some of them are already breaking ground, and they really are going to need those funds in order to continue their construction and hiring of workers.
Is there any sense here when we talk about the progress that those companies are making, and we've already heard from the Biden administration, particularly when it comes to Intel and a couple others, that I guess they want to see more milestones reached before they disperse those funds. Are those companies on track to actually meet those targets in anticipation of actually getting that money, Sarah?
I think that some of them are having trouble moving forward because they don't have access to the funds or they don't know when they're going to receive the funds. So there's a hesitation on their end as well to continue building up their facilities in the U.S. And really, that's what all of this is about, is building up resiliency in semiconductors in the U.S. And we need funds to do that because these facilities are so investment intensive.
Yeah, and even for the companies that do have the funds to build out the facilities, and I'm thinking of TSMC trying to make Arizona its first major U.S. hub for chip production. The two factories that it has planned are delayed, and in part, that's an issue of talent and not being able to identify the right kind of talent in Arizona. How long does it take to kind of work these things out? It feels like you'll need at least 4 or 5 years to be able to get a pipeline in.
Yeah, I think it takes a lot more time. Thousands of jobs need to be created, and we really need people who are highly trained. They can train some people at sort of the lower level types of operational positions, but having people do the more higher tech types of clean room jobs requires a lot of technical expertise and training. And in fact, this might be closely tied with potential immigration policies, because we may actually need to hire some people from other countries, potentially excluding China, in order to get the expertise that we need.
Sara, I am curious here about the output, the idea here that right now you have protectionist policies here in the U.S., at least with regards to some of the more advanced chips, particularly those involving AI, and trying to keep them out of the hands of China, trying to keep them out of the hands of Russia and other states that we apparently have issues with here. But there's a great story on the Bloomberg terminal today about some of the workarounds, at least that Russia has used to get its hands on some of that technology. How realistic is it to sort of put up those guardrails to prevent the folks that we don't want having those chips not getting them?
It's extremely difficult. And, we know that from trying to implement all of these export control restrictions and other types of restrictions, that it seems the companies that we didn't want to obtain these chips, like such as Huawei and other firms, have been able to access them somehow, either through informal means or indirect means, or perhaps they were able to get them through buildups of inventory among other distributors. And so there's so many workarounds that we did try to address some of the loopholes previously, but really it's kind of a whack-a-mole process.
All right, Sara, I'm going to have to leave it there. Sara Hsu, Clinical Associate Professor of Supply Chain Management at the University of Tennessee, Knoxville, as we round out the show here with a push ahead of some of the things you should be keeping your eyes on. And we start in the morning with a whole slew of earnings.
Yeah, McDonald's, of course, in the headlines for things other than its earnings, but it will be up, on the docket for results. We also hear from D.R. Horton, the home builder, along with a couple more energy companies like Phillips 66. Also after the bell, we're going to get some big ones as well. Google and AMD, two of the most important ones to keep an eye on. Chipotle also scheduled to report as well. And then at about 10 a.m. in the morning, we're actually going to get the drumbeat. I know you love this, Scarlett. Yes.
To the big jobs report on Friday.
Yeah, JOLTS, job openings and labor turnover survey that comes out. People will watch it carefully for any kind of read-through to the non-farm payrolls number and the consumer confidence from the Conference Board in particular.
All right, and we don't get any Fed speak, a quiet period for them, but we are going to hear from the Treasury Secretary, Janet Yellen, scheduled to address the American Bankers Association convention tomorrow. A lot of questions right now about fiscal policy as well as politics. Balance of Power is coming up at the top of the hour. I think they're going to provide some answers for you right here on Bloomberg.